Now let us see an important measure of market risk, that is value at risk, which basically measures the downward potential of any position. Basically, the value at risk is an advanced methodology to measure market risk because it uses the price sensitivity and also the probability. So value at risk is a statistical estimate of the maximum amount of money that may be lost on a portfolio over a given period of time with a given level of confidence under normal market conditions. So the presumptions are the normal market conditions. So what does the value at risk will tell you? Basically, it answers the question what loss level is such that we are X% confident it will not be exceeded in n business days. So basically, the value at risk is defined as a loss level that will not be exceeded at some specified confidence level or a specified time horizon under normal market conditions. So it uses a probability and tells you what is the downward potential. If the VAR horizon for 1 day horizon and at a confidence level of 95% is say 1 crore, it says the likelihood that our losses will exceed 1 crore over next 24 hours is only 5%. So that when we say this with 95% confidence, then there is a 5% possibility that the losses may exceed the VAR number. So VAR basically asks how bad things can get, and it summarizes the worst loss over a target horizon with a given level of confidence. And basically it is important that VAR gives a single number. It's a currency amount which estimates expected maximum loss, worst loss over a given time horizon at a given confidence level. But one thing you have to remember is VAR is not the actual loss. It is only a probabilistic maximum loss your portfolio can take. It basically describes the probability boundary of a potential loss. So we have underlying word is the probability. It is the probability boundary. VAR an estimate of the likely loss. So actual loss may differ, and of course the Basel BIS, the BCBS has also accepted VAR as a market risk measure for provision of capital adequacy. And we know that the VAR measurement is applicable only in normal market conditions, and it is also used as because regulators uses this for capital charge. It also used as a stop loss limit in addition to the cumulative loss limits. And it also, because VAR throws out a single number, it is very useful in the integrated risk management because you can aggregate the risk if you know the VAR numbers. And all the models which are used for computations of the VAR needs to be back tested, and the VAR complements the stress testing. Why VAR is popular? Because it represents the risk with a single number rather than giving different risk factors and then we estimating individually, then aggregating. And it works as a very important comparative when you are comparing two portfolios. So we know that by knowing the VAR number, we know which is more risky. And it is used for market risk computation. We have seen that. So in fact, the central banks have made mandatory to the most of the banks for quantifying the market risk, they should use the VAR measure. But here, when we say higher the VAR, higher the capital charge. So there is a tendency amongst the banks to choose those models which will throw out lesser VAR numbers. So the model validation becomes very, very critical. So the regulators will insist on validation of the models before these being used for maintenance of the capital. Regulators also provide certain norms like backtesting, data period, minimum period which you should use the historical data, what kind of data is to be used, and the estimation methodology, so that because since it has been used for maintaining the market risk capital, there is a tendency amongst the banks to underestimate the risk. The regulators are going to stipulate a lot of norms for computation of the VAR. So VAR again is subject, since we are using the models to compute the VAR, like any other estimate, it's again subject to the model risk. It also has an implementation risk, and we have seen that one of the important assumption is the normal distribution assumptions. So you must be aware of the limitations of the VAR number. So VAR itself is not a risk management, it's only one of the tools of measuring the market risk. So some of the VAR models use historical return data, presumption that past is reliable guide to the future, but this is not always the case. And a single VAR figure may give misleading information, because two different portfolios may have a similar VAR numbers at same competence level and holding period, but have a in actual reality they may pose different kind of risk. So one of the important challenge of computation of VAR is capturing the reliable data, and it's very data intensive, the VAR computation. And different methods of VAR can give different VAR numbers. So basically there are three approaches to the computation of VAR: historical simulation, variance-covariance, which is known as analytic, and Monte Carlo simulation. We'll briefly see how these methodologies are used. Basically the historical simulation method, which is widely used because of the simplicity, because it uses the the historical data relating to the particular position, and uses those time series to compute what is the expected loss in future by way of a VAR number. So it uses the historical returns, and it predicts the future changes to the current exposure. So what it does is it takes your current portfolio and calculates the returns on the portfolio going back to 50 days and 500 days, the number of days stipulated by the regulators. And basically the important assumption here is the past changes are reliable guide to the future changes. So the question we ask here is, what if future returns are just as they were in the past? How would the current portfolio value be affected? So basically it assumes that whatever changes which are happened in the past may get repeated in future. So this is the methodology: measure the current portfolio value or current exposure in rupees, current weights, and measure returns for the past 250 or 500 trading days, and multiply all past returns by current portfolio value and add the resultant loss or profit across all the days. And VAR, you know that depending on the level of competence we are looking for, rank all the worst total losses to the highest profit. So probably we will end up, if you want 99% competence, you take the worst loss as the loss VAR number. And if you are looking for 95% competence level, probably will take the last 5 worst losses and average them. That will be the VAR number. Variance-Covariance method assumes that all risk factors and asset returns are normally distributed. As the portfolio return is a linear combination of the normal variables, it is also normally distributed. That is the one of the presumptions which the Variance-Covariance method assumes. It measures the current portfolio value or current exposure in rupees, current weights, and then calculate the returns for the past 250 or 500 days, and that is basically the convert the past price data into return data, and thereafter the methodology is quite similar to what we discussed in case of historical method. So this is basically the statistical methodology, how do you calculate the variance-covariance VAR number. Monte Carlo is quite similar to historical simulation, but uses random numbers to simulate losses rather than actually using the historical data. Forms the distribution, uses the historical numbers to estimate the distribution, and then as far as the future rates are concerned or volatilities is concerned, it use the simulations, possibly different paths, and probably then striking the most possible path using the very intensive data intensive and very system intensive methodology. And it will revalue the current portfolio with different random numbers, and then finally throw a number which is most likely to occur. So whatever may be the VAR model you are using, important thing is you need to backtest. Backtest is by actually computing the P&L for a day, taking the real market values and then going back and checking whether your VAR numbers exceeded the actual loss, notional or whatever you are calculated, whether it exceeds the VAR. So always whatever P&L you calculate succeeding day, it should be less than the VAR. So if actual losses exceed the VAR number, that probably is, depending on the number of times this kind of what is outlier events or the number of days the actual loss exceed the VAR number. If it is more, there is something to do with the model, VAR model. So one of the validation tests for the model is the kind of back testing and how many times the loss exceeds the actual VAR number. It is important to use VAR as a the market risk control measure. It is used for reporting the risk. If you have a portfolio of foreign currency and equity and all, so one number which can aggregate different the risk across different kind of portfolios. So it is used as a for the reporting risk. It is used as a defensive tool to controlling risk by risk limit in addition to the stop loss limits. And actively it is used for performance evaluation, capital allocation and strategic business decisions. So currently some of the the banks use VAR limits for allocation of the capital amongst different business units. So now what is the stress testing? Stress testing is basically to see that in the worst scenario whether the bank is in a position to meet those kind of situations, and one is going by the historical scenario. When you capture the exposures of a portfolio in the trading book, portfolio to adverse discontinuous market events which are extreme but possible. Historical scenario, you have to isolate the exposures to the extreme historical events which exceed the loss threshold determined based on statistical measures like VAR. Suppose you have set up a VAR limit of say 10 crores, and out of the last 250 days, if there are 4-5 occasions, basically you have to this becomes exceptional days, and this needs to be isolated. And hypothetical scenario can also be created to stress test, to identify exposure to the extreme but possible future market events which have not yet occurred in the past, but past performed at different levels, individual asset classes to portfolio level to the bank's portfolio as a whole. So this is basically when you are stress testing to see your exposure considering the hypothetical scenarios. So it is used for risk monitoring, control and reporting. Now let us see how the market risk needs to be monitored, controlled and reported. One is the proper delegation becomes very, very important, whether by way of a stop loss or by way of various other risk limits. And the product risk need to assess various products whenever there is a change in the process to revisit the risk associated with all the products. Limit on the portfolio size and mix, like if you are having an investment portfolio, you can set up limits on the kind of SLR, non-SLR securities we can hold in the portfolio. So we can also decide on the kind of exposure to the equity market. You have to set out a clear mark-to-market policy and frequency at which your position needs to be mark-to-market to quantify the losses. Limit monitoring and reporting becomes very, very important, and the stop loss limits mentioned in terms of amount absolute terms or in terms of the basis points or the moment in case of exchange rate becomes very, very important. And independent testing of financial models, whether it is used for computation of duration or VAR, is another important task. Periodical stress tests and well documented model validation policy and the prompt reporting of the limits and violations. Now, as far as the risk mitigation, market risk is concerned, one must remember that the whole idea of creating a trading position is to make profit. If we have to mitigate the risk associated with the trading book, probably we are capping our upward potential also, because the volatility and the returns are correlated. If higher the volatility, higher the profit, at the same time you are exposed to higher risk. So whenever you mitigate a market risk, to that extent you are capping the upward potential. So strategies are where, because the movement in the market prices comes out of the sensitivity measure, so better to keep the sensitivity low by keeping the duration low or PBBP low. And correlation measures, like exactly having a negative correlation, you know that there exists a correlation between different markets. So better, if you want to reduce a risk of interest rate risk, if a particular position will go adversely against you, if the interest rate goes up, you need to have another position which will have exactly opposite impact when the interest rate goes up, so that end to end you will have a lesser losses because of the interest rate movement. So it's like long on stock and short on futures. Basically it nullifies whatever gains you are going to have. But these are some of the risk mitigations, market risk mitigation strategies. If you have a fixed rate bond, you can have an IRS so that you are not affected by the the interest rate movement. And you can use the market instruments like forward contracts, interest rates, swaps, futures and all to minimize the volatility in the portfolio. So let us check our progress. Bank is wanting to sell a major holding of corporate bonds. The market liquidity is tight with cash shortage. What kind of risk the bank is facing? We know that when there is a overall liquidity shortage in the market, generally we call it a market liquidity risk. So the D, market liquidity risk, is the correct answer. Macaulay duration, which is basically known as duration of a bond, is 5.6 years and yield to maturity is 8%. Sorry, it is 5.6 years. What is the modified duration in percentage terms? So the duration and yield to maturity, we know the relation that mod duration is Macaulay duration divided by 1 plus yield. So 5.6 divided by 1.08 is 5.19. So the B is the correct answer. An Indian bank holds a foreign currency bond denominated in USD and rated AAA. The bond is downgraded to single A and Indian rupee has strengthened against USD. The bank faces, we know that any investment which is denominated in foreign currency is subject to exchange risk. And if there is a rating migration, AAA migrating to A, definitely there is a credit deterioration. So the bond is exposed to the credit risk also. So B, exchange risk and credit risk, is the correct answer. A dealer has to pick up from two bonds having similar yield to maturity A, this is the first bond having 5 years duration, and another bond is having 5.7 years of duration. Which bond is less risky? The higher duration will be more risky. So here the less risky bond will be bond A, which has 5 years of duration. So the correct answer is B, bond A. Thank you.